market overview of everything that's going on at the moment as we approach the fourth quarter. Now this is important because obviously it's been a pretty flat month so far, a flat year so far, and so now the issue is whether we're going to get a bit of a bump up, and what is the case for getting a bump up to the end of the year in the markets. And I want to give an overview of that. I want to sort of explain to everybody, based on my analysis, the analysis of some of the big key players out there, what I think the closing to the year will look like. I want to condense all this rather complicated information in one short webinar, because I think it'll save you a heck of a lot of time if I do that, because I've spent hours and hours analyzing all that data. That's my job, and what I want to do is be able to give all that quality information to you. I'm going to break it down into several categories. First of all, key market overview. Then I want to go into what actually excites me about the markets at the moment, what I see as being good opportunities, what I see as being the areas where we're going to be able to make money, how I use ShareScope, the Alpesh Patel Special Edition, in brief outline, because that'll help you then work out where you yourself will be able to make returns. And then I want to round off with what actually keeps me awake at night, what's actually worrying me at the moment in terms of what's happening in the market. This will balance out everything in terms of giving you a broader context, not just the upside but the downside, but also addressing some of the common concerns people have based on what they hear and read in the media. So let me kick off, as I say, straight away, just to give you a bit of background where I get this information data from, as well as my own analysis using ShareScope as well. My fund, my private equity fund, uses Edmund de Rothschild on the private banking side, so we get a lot of their data. I use the Bloomberg briefs. These are only available to those with Bloomberg terminals, so it's a pretty expensive piece of research that I get access to, which I then distill. As you can imagine, there's a lot more data than you need to know. I want to distill all of that for you, and then a variety of private banks who keep me informed and appraised of all their research, from Goldman Sachs to Coutts Wealth Management to Deutsche Bank's Private Wealth Management Group, ABN AMRO's Private Banking Division, and so on. And I've taken some of their clippings and headings here, show you where I'm getting all this data from, and as I say, incorporating all of that is what you see in ShareScope and how I analyze that. My job then is to distill that, communicate that, make it digestible, make it something which is understandable for you, summarize it to essentially make your lives a heck of a lot easier. Now, I've got to give you some important notices beforehand. If there are any stocks that I mentioned that I do have a financial interest in, I will of course disclose that, but there might be nothing stopping me from mentioning something which, I don't know, for some reason tomorrow or next week I may end up owning. I should say nothing that I do mention I have any intention of in the immediate future owning, not that that there's likely to be a market movement from what I'm about to discuss as a result of this in any event, so I don't want you to be too worried about that. I've got one individual still saying I'm unable to hear, but everybody else says they can. I'm wondering whether that might then be a problem at the other end and not at mine. I've got others saying hear okay and can hear now, so I think it must be a problem at the other end. What I will be doing is recording this at webinar and uploading it. I'll give you the address we're going to upload it to at the end, so you will be able to get access to this as a video recording as well, in case you do have any audio problems at the moment, which could then be fixed in due course. But everybody else is saying your audio is fine, Alpesh. So I'm going to continue without any more comment on audio for now. And now, just going on again, if I do mention any margin products, whether they're spread betting or foreign exchange or any such things, then please do be aware, of course, of the usual risks of using margin products. And I will always highlight risks. As I mentioned, foreign exchange is one of those. And similarly, the idea with this presentation is it's educational. This is not advice on your personal circumstances or financial situation or your financial objectives, because I don't know them, what they might be. This is more general and generic advice, both educational and also in terms of how to trade, how to invest, how to analyze the markets. What I try to do is make sure that in the next hour or so, 45 minutes, people get absolutely the best information they could possibly get about the markets in the shortest space of time, and it's the most efficient time they'll spend, and hopefully it will either save or make them a bit of money as well. Just for those who don't know, just to give you a bit about my background and credentials, I've written, it's now some 16 books on investing, including one this year called The Online Trading Cookbook, published by Wiley, and these are some of my company's paying clients, all the way past and present, all the way from American Express and CMC and all the others you can see over there. So let's get into the meat of it. First and foremost, the big question, is the market overvalued? What I want to start off with is the statistic that actually back-to-back gains in the S&P 500 in the first 2 months of the year have occurred in 24 of the last 66 years, and they happened this year, by the way. The average gain during those 24 years, when it did happen, has been 19.4% with not a single down year. I, therefore, based on that statistic alone, do not expect a down year this year in the American markets, and the British markets tend to follow the American ones, so I don't expect a down year. Will we be up 20%? Well, that would mean pretty much a 20% rise from where we are at the moment. We may not be up as much as that, but I certainly expect an up year, but not just on that statistical fact. I'll have to give you more than that, won't I? I'll have to give you information about earnings and so on, which I will do. Incidentally, the UK is at an all-time high. If you take the FTSE 100 total return index, which includes dividends, we are at an all-time high, and by that I mean we are above even our 2008 peak. For those who are interested in technical analysis, we do, however, have some reasons to be cautious in that the momentum indicators are at best overbought, at worst showing a negative divergence, which tends to be a bearish indication. Those kinds of things I explain on my other webinars, and I'll give you the address of where those are as we progress, but also I also explain on the Alpesh Patel Special Edition education part as well. I will leave an address for you where all my webinars are available for free. All this is for free. I'll leave that for you now as well as at the end, and this is where you'll be able to see all my previous ones, and they'll be useful not just because of what I'm discussing about the market at the time. You'll want to listen to those for the educational part, because obviously the markets move and change and so on, but the educational part always stays the same. So that's where we are with the FTSE 100. What about today? What's the big item today? Well, I started this morning with a teleconference with the Economic Times of India this morning to talk about the European markets. That's what they wanted to talk to me about. And in particular, the key thing on their minds, of course, wasn't anything to do with what's happening in British politics, but actually was about the ECB, as we would expect. Now, let me tell you what I think is actually going to happen with the European debt crisis. The European Central Bank will come through on buying government bonds of the member countries, which are the most highly indebted ones, and that will drive down the yields, basically what those governments have to pay to service their borrowings and their debt. I will not in this webinar go into all the whys and wherefores and all the rest of it, but clearly the short-term biggest problem is how much governments are having to pay for their debt. And that short-term problem is most easily alleviated by those with the biggest and deepest pockets, which is the ECB, because it's a collective, okay, it's largely Germany, but it's a collective of all the European governments plowing money in. They've worked that out, that why don't they, instead of targeting inflation or targeting growth, why don't they solve the near-term problem of lack of confidence and lack of credibility in the individual governments by collectively stating that they will target debt yields by buying bonds, thereby pushing up the price of bonds and pushing down the price of government debt. The bottom line is, to make things even simpler, I'm not worried about Europe and the euro crisis in the short term. The politicians seem to be getting ahead of the media cycle and therefore getting ahead of the panic that traders love to cause. They're staying one step ahead by having the meetings 2 steps ahead of the traders even getting worried. And that's why we've seen the euro, whilst it's come off a fair bit, it's certainly not at all-time lows, and it is starting to show some signs of recovery, and we're not talking about panic. So that's what I think will happen. What actually is getting me excited, that's, as any of you who've ever met me will know, that's actually not me. I wish I had that much figure. I wish I was that much hair. I wish I had that slim figure. One of the things that gets me excited is actually the last 3 months of the year tend to be pretty good. The average monthly performance since 1990, so the last 22 years, in US and UK equities has been pretty good for the last 3 months of the year. In fact, you could argue that all you should do is invest in those last 3 months and stuff the others. It's not worth taking the risk, certainly not. Look at September, which is what we've just entered. So isn't it good that we're having this webinar on the second working day of September? Thank you, ShareScope, for organizing that. So there you go, September not so good, but October, November, December, we are getting well set up. So again, you could argue, well, Alpesh, you're talking about statistics. Well, yes, but initially I mentioned the statistics for a whole year. Now I'm just mentioning and narrowing down statistics for individual months. I'll actually come down into more fundamental reasons why I am relatively bullish on equities. Now remember, I'm not selling a fund to anybody, so I'm not a long-only fund manager. So I've got no vested interest in trying to talk up the markets. I'm not a bank. I'm not a stockbroker. So I'm not encouraging you to go there. I make no benefit out of any of this happening, whether the market rises or falls, which allows me to be detached and I hope more credible as a source of data. But not only that, the source of this data is Bloomberg. I'll always give you the sources of my data because I don't want people just to take on faith what I say. I want them to know the reasoning behind it and, even more importantly, learn so they can do their own analysis themselves. Here's another interesting statistic. The S&P 500 traded at 14.1 times earnings when the market hit its most recent high on March the 1st. That's the lowest valuation of any 52-week market high going back to 1989. The ability to scare the hell out of people is much greater than the ability to attract them to equities. So what we see here, I suspect, is greater fear than there is an attraction for equities based on their valuations. Now, of course, P multiples, like 14 times earnings, tend to be lower anyway in a low inflation environment, in an environment where interest rates are low as well. That's just the way the financial mathematics works out. What the bottom line of all of this is that the market, you could argue, could trade higher based on the earnings it seems to be generating and the multiple it's trading at. Bottom line, in simple terms, valuation suggests we could be trading higher. Okay, let's take Goldman Sachs's view. This was their price target for the S&P 500. And remember, as go the American markets, so often go the British markets. These were the targets, 12-month end for end of December 2012, 1450 on the S&P 500. Again, that gives me cause for thinking the markets will move higher. Where are we at the moment on the S&P 500? Well, we're bordering along the 1400 mark. Tells me that there is room for maneuver. Maybe not a 10% rise according to the S&P calculations, but as I said, I'm relatively bullish. The one thing which would get me worried is this negative divergence, as technical analysts call it, because there's a higher high in the S&P 500, or at least a matching high, but the technical indicators haven't done the same. They've gone in the opposite direction. That suggests very often a falling off. Will it happen? Well, for the reasons I've given above, I'm not sure it actually will get a sell-off, but there are therefore reasons to be cautious. It's certainly not a no-brainer. What other things should I be worried about which might put me It's some little bit of an unease. Well, Europe I kept getting asked about. Of course I get getting asked about Europe. Should I worry about Europe? Well, to a little extent. The short-term problem I already explained to you, I think, is easily solved. The ECB starts buying bonds, and it will do that. And I think it'll do that because, very astutely, a lot of the ministers have painted the Germans into a corner whereby if now they don't do it, the markets will tank because of the expectations which have been built in. So there's been some game playing going on. What about the longer term? The longer term problem is relatively simple. It is to do with European unit labor costs. In other words, people don't want European products, and therefore the markets, therefore their growth is diminished. They don't want them because they're expensive. It's not to do with quality, it's to do with expense, and it's also to do with global demand. Well, I'll get to global demand in a second, but the price is, of course, a key factor. What's the key factor in the price of a product? Labor costs. What if labor is too high? Well, look at this. What a coincidence. In Greece, which has the biggest problem, also tends to have the highest European unit labor cost. They want to be paid the most for what they do. Ireland has sorted itself out, reduced its labor costs, got itself out of a recession because it's made itself more competitive. What's the other way of reducing unit labor costs? You devalue your currency. Well, the euro has more recently been falling. That's good for reducing labor costs. The other way to reduce labor costs is, of course, you put a freeze on salaries or even a cut. That takes time because socially people end up going to their unions, having riots when they're being paid less. I'm not making a moral judgment whether that's right or wrong or a political point, just an economic one. That if salaries get cut, that will make Europe more competitive and will actually perversely be better for everybody concerned because things get cheaper, people buy more of it, and your job security increases. That's the theory at least. I'm not here to discuss the politics, but that's the theory. In other words, my point is the answer to European debt in the longer term is also soluble, is also solvable, is also something which can be done and solved quite nicely. So, given that that's the case, let's move on to other things which might worry me in the future. What about UK GDP? Not so much, actually, because that's the forecast. Yes, you might say, well, of course that's the forecast. Forecasts are always positive. Well, actually, this is the Bloomberg forecast from the analysts that they've been speaking to, quarter-on-quarter percentage changes. I'm anticipating in 2013 a resumption out of the recession into positive growth. Why? Because recessions tend, negative growth tends not to go on forever and ever and ever, thankfully. So, you know, it's not at least a forecast of increasing GDP fall. That should build confidence. Confidence is the thing we need at the moment. What about other things where I might be a little bit excited? What gets me excited? Well, the euro weakness is actually a positive thing in very many sectors. The ones with the lowest risk are those which have the least revenue exposure to Europe. Energy, low risk. Technology and hardware, low risk. Pharmaceutical companies, low risk. You want me to name names? I can do that. Which companies have sales outside of Europe? Revenues excluding Europe as a percentage of their total? Rio Tinto, Nestle, LVMH, Sanofi, and so on and so forth. London Stock Exchange, Ryanair, not so much. So my point being, which ones might you be particularly wanting to have a look at? Some of these companies, which remember on ShareScope you can look at the ADR, the American Depository Receipts, which these are listed on, as well as the ones listed on the UK exchange as well. I'll get into specific stocks later and give you my views on which stocks I particularly like later on. The other thing on indices, what also gets me excited on when we look at foreign exchange, is the dollar looks overstretched. Now, what this is showing you, going back to 2004 all the way up to the present day, is the net position in dollar speculators, the contracts, and where they are, and two standard deviations, don't worry about that if you don't understand those, on 1 year average of where it tends to be. The dollar seems to be getting a little bit carried away with strength. In other words, I expect a weakening of the dollar against all major currencies, certainly against the euro. And I would at this point turn positive on the euro against the dollar over the next month to 2 months at least, partly because of this, partly because I think the European situation will turn around. But remember, that's a 1 to 2 month view, and therefore you don't want to go in heavy into those positions and end up losing your shirt in the short term. What keeps me awake at night? Before I go into individual stocks that I like, and by the way, President Obama doesn't keep me awake at night. That's just a picture which looks like something's keeping him awake at night. It's probably not Mitt Romney, though. So what keeps me awake at night? Is it the U.S. deficit? To some extent, yes. And the reason is they've got something you're going to hear more and more about called the fiscal cliff. That's where they've got a lot of bonds maturing and they need a lot of money fast. And they're going to need it fast and they're going to need it soon. Will they get it? Probably. Will they end up having to pay a lot more for it than they can afford? Well, they've always been used to paying more than they can afford and spending more than they can afford. And the reason I mention this is this. Imagine this apple pie tray as being the entire budget, US budget. The Apple bit is their revenue. The gap is the deficit. In other words, this is a total of how much they spend. All of this tray is how much they spend. The Apple filling, the bit that's still left, is how much they get in revenue and therefore finance through tax and so on. The gap is how much they end up having to borrow. What worried me is that the Republican Party, the GOP, the Grand Old Party, and the Democratic Party, the kinds of cuts they're talking about are these kind of crumbs. They make no difference to the size of the deficit, the total deficit. They make absolutely no difference. So this problem they're going to have about financing that debt is going to continue, which is one reason for assuming sooner or later, and it's not going to be in the next quarter, the dollar will weaken, and they will also have problems. It does keep me awake at night, but not for the next 3 to 4 months. Not a problem, even with a U.S. election coming on. In fact, despite a U.S. election coming on, I'm not worried about that in the short term, but long term I will be. What does it actually mean? Well, it means they have to keep on lifting this statutory U.S. debt that they have, where they have to keep on authorizing through Congress more and more debt. And you can see from 1995, this debt ceiling has kept on going up, and so has the price of gold. Gold is linked to the value of the dollar. There's either this is coincidence or there is causation and correlation, and I suspect there is causation. So I've got a strong reason for thinking gold will continue going up. Am I worried? Does it keep me awake that China is slowing down? Well, as I said, after this webinar, I've got to run to the BBC studios and discuss and talk about India. So does it to some extent worry me that China is slowing down? Well, no. Actually, you'd think it does keep me awake at night because Chinese GDP year on year has been declining, and therefore if that declines, surely UK equities will suffer, given that a lot of our companies are export-based. But I think it's been a managed slowdown to control inflation and social unrest. The Chinese, with their control economy, are doing this purposely and very deliberately, so I'm not worried. The other reason I'm not so worried about China and India slowing down is this. What market? Market for British companies, for American companies? You know, you keep on hearing about it. Well, actually, this is what the world would look like if you resize the countries based on the number of people living within them on less than $1 a day. India's full of people living on less than $1 a day, so is China. Well, market for what then? Hardly a market for most British company products in any event. Of course, it's a nice to have, and of course for WPP, Brazil is important, but look, Brazil is important because it's not got so many people living on less than $1 a day. India, yeah, it's a nice bolt-on, but nothing as significant as you'd think the media would have you believe. Similarly with GDP by 2015, if this is the GDP map of the world, based on if each country was the same size as its GDP, well, look at Europe. Incredibly important is Europe. Phenomenally important. Not so much China and India. Of course they're important, but not that important. And America's important. In other words, well, actually, I'm not kept awake by any degree of Chinese slowdown, for instance. What about government debt levels? Well, I've already answered that. In the short term for Europe, the answer will be solved. In the longer term, we know what we need to do. Japan, as a percentage of GDP, has been the world's second largest economy up until this year when China took them over. This is source McKinsey. And yet, it has debt to GDP far greater than virtually anybody else. I mean, the Italians have been running their debt to GDP and on the brink of bankruptcy and hitting a recession every other year since about the 1970s. They're used to it, they're managed, they muddle through, and when you give people no choice, they somehow do seem to survive. US S&P earnings growth, does that keep me up at night? Yeah, to some extent. Earnings growth has been diminishing. S&P 100 earnings growth, the growth of the S&P 500 companies, their earnings figures have been dropping. That suggests valuations could now diminish because we don't keep on getting lots and lots of profits. If we don't get profits, then if we don't keep on getting profits, then what happens? You get the stock market gradually dipping off. Am I desperately worried? Not so much, because the expectations are coming down and have actually been pretty down as well. S&P growth, earnings per share, another way of looking at this, there you see earnings again forecasted somewhat lower. So because our expectations have come down anyway, you're still going to get surprises. When you get surprises, you get the price moving up and therefore the index moving up. So again, I'm not that worried. In fact, according to FactSet, US S&P 500 earnings growth may be negative once the largest companies are excluded. Now, does that keep me up at night? Yes, somewhat it does keep me awake a little bit at night, that earnings growth is actually negative once you exclude some of the really big boys. And as you can see, if you exclude Apple, which is one of my favorites, then it gets negative very quickly. So do watch out for that, and that does worry me to some extent. I've got to look at profitability of companies, not just the big ones. The good news is a lot of these companies, through their retained profits, are increasing their dividends. That's why you're seeing returns and share prices holding up, and that's good news. It's not necessarily bad, and that might see them through the bad periods. And I mentioned how I use Alpesh Patel special edition of SharesGate. Well, as well as giving this monthly newsletter that I do, which is a rather detailed newsletter based on about 100 hours of research during the preceding month that I do, and webinars and so on for all the Alpesh Patel special edition users. One of the things that I also do is explain various bits of the Alpesh Patel Special Edition. And one of the things that I like to look at is the value growth filter. And I explain in detail what the value growth filter does. It looks for stocks which are relatively undervalued based on a weighting according to various characteristics that I use for weightings, and also companies which are growing on earnings and revenue. They're all then put into a mathematical formula, and then they're given a scoring. Which allows me very quickly, saves me a lot of time, allows me to see which companies I want to concentrate on, for instance these, which come up with the highest scoring and gradings on there, and their short-term momentum, so they seem to be rising as well. And it allows me to find companies like Aberdeen Asset Management. Right over clicking, you can see the nice little upward trend, and that one's done about a 50% return this year, actually just slightly shy of 50% this year, and so on. Babcock, another one which I've been banging on about and has been doing well and still looks to be doing well, even though the technical indicators are somewhat overbought. Also, on the table that's in the Alpesh Patel Special Edition, what I tend to use is I rank stocks on the value growth rating, just generically, not just through the filter that I just showed you, but actually just all the stocks, let's say in the FTSE 350, like I've done, say here, and see which ones have the highest ratings, and then it allows me to see which have got, say, the lowest rolling PE and so on, or I just scan through them and look at graphs like this. For instance, one of the most important things that I do, which I think is in actual fact one of the most valuable things you can do, is look at the time frame that you're interested in, like the weekly bars here, and the time frame one further out, the monthly bars, because the markets tend to move a bit like waves. You've got longer term investors and shorter term investors, and so one of the things you've got to do is, in actual fact, very importantly, is to make sure that the short-term money and the long-term is moving in the same direction. They tend to be the biggest moves. So, as you will have seen in the previous chart, I here found, for instance, here, Alpesh value growth, and I then looked at the weekly and the monthly. And one of the things that I think is incredibly important, if I see the MACD on the weekly rising and I see it rising also in the monthly, that suggests to me that that is a stock which is going to continue moving upwards for a while. And you can see here, a classic example is at the start of the year, you saw the MACD rising on the weekly, and at the start of the year here, you saw it flatten and then start to move up, and the market just kept on rising from the start until about middle of April, and had some degree of momentum behind it. So as long as the term period you're looking at and the longer term, the MACD, are moving in the same direction, that's when you get the biggest moves up. I'm not saying it's absolutely vital to do that, but I find it as a useful thing once I've already looked at the value growth rating and seen that that's at 9. And that really narrows down the stocks I'm going to be interested in. I want things with value growth ratings of 9. It's the first thing. And the next thing, and I'll click on the weekly and I'll click on the monthly when I look on the Alpesh table as a result, and I want to see them moving in the same direction. I want to see the MACD on the further outward period just being flat at the very least, if not moving up, and I want to see it on the weeklies actually moving upwards. And those that saves me hours, absolutely hours. Not only that, of course, in the monthly newsletter I highlight these in any event to save even more time, because I think people just spend so much time analyzing stocks not knowing what to do. They really need scores and they need to know quickly what to do. Look at some of the other attractive ones I like. There you see the monthly MACD still going upwards. On Bellway, it had its results recently. But if you don't necessarily like what I'm talking about, this is from Deutsche Bank, for instance, gives you some of their analysis. This is the kind of thing that I include in the monthly newsletter that I give to the special edition users, so that they can see what the big investment banks are saying to people and what their rationale behind stocks and equities are. These kinds of ideas only go to the highest net worth individuals and members of those banks. And so what I tend to do is include that in the monthly newsletter. Been asked, where can I read more about the Alpesh Patel Special Edition? That's obviously on sharescope.co.uk, and I think that is the URL is /Alpesh. So it'll tell you more about that. Most people actually, well, many, get it as much for the additional scoring that comes in the filter as they do for the newsletter. Funnily enough, we didn't anticipate it to be that way, but it is, and that's fine, and we have no problems with that. Let me just very quickly, before I talk about more specific stocks again, talk about using the special edition features. One of the features I get a lot of questions about is the momentum indicator. What does that mean, or the momentum radar rather? What does that mean? What are the short term? I created this bullish momentum filter, but it does seem to cause a bit of confusion. So let me clarify. For short-term trading, my favorite first stop is the momentum radar. Here I look for stocks which in the time, for example, daily, are showing a MACD being flat to rising, preferably below the midline. I want to ensure the MACD is not falling in the time frame further out, as I explained already, the weekly in this case. So why the bullish momentum filter? This was to give me a starting point to find stocks which fall in the categories I've just mentioned above. I never follow it blindly. Sometimes I might not follow it, but that's the reason behind it. Is it gives me a starting point to find stocks which fall into the category that I mentioned. Now, obviously, momentum is a separate conversation. I give that on my free webinars. I give it on my monthly newsletter. I give it on the help section of the special edition as well. So I want to make sure that you know that there's also these free webinars. This website's completely free as well, alpeshpatel.com. You can register there. You'll get access to the webinars and all my other free information and free data and everything I've got. It's not just FX, I should say. This is an earlier screen grab. Has all sorts of other stuff on it, including upcoming webinars and stock training, all free. Not selling anything on there, just lots of videos and the like on there, just lots of education, which I hope that users of my stuff will find helpful. Now, it's, I hope, been of use to you. I've already mentioned that in this webinar you will be able, give me about 24 hours, in 24 hours uploaded on alpeshpatel.com/webinars. I will be endeavoring to do more monthly. For Alpesh Patel Special Edition users of ShareScope, you can go to ShareScope's website, and there you can find out more about the past performance, how well I've done on this, using the indicators that I've got here, and that also includes a monthly newsletter for free to APSI, Alpesh Patel Special Edition users as well. My idea is I want people to be educated as much as possible so that more of their finances are in their own hands, because as we've already seen, what happens during the credit crunch, we end up getting stuffed by those that we trusted the most. As I said, all questions, because time's a bit short, I'm running to the BBC studios as we speak, please feel free to question me about anything, whether it's the markets or about the Alpesh Patel Special Edition or anything else, on Alpesh Patel, alpesh.patel@tradermind.com. do hope that's all been helpful. As I say, lots more webinars on the website above alpeshpatel.com/webinars, and this one will be uploaded there in 24 hours. And I'll be looking to do monthly webinars for the Alpesh Patel Special Edition users, and the free newsletter that goes to those users as well. I hope that's going to be lots and enough information for you, which will include stocks that I like, what my views of the markets are, where I think they're going, and so forth. I hope it's all been useful. Now, I know that some had some sound problems with this, and that's why we're going to record. We have recorded it, and so I hope that you've all found it very useful. Thank you all kindly so much for tuning in, and I will let you have details through ShareScope of the very next webinar that I do, and I always try and pick an educational topic as well as what I think is happening with the markets and which particular stocks and so on that I like.